Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at DealCatalyst. Joining me today is Fabian Chrobog, founder and chief investment officer at NorthWall Capital. Fabian, appreciate your time today. Pleasure to meet you virtually. How are you doing?
I'm doing good. How are you, Todd? Nice to be on.
I'm doing very well. Well, we very much appreciate your time. So,
pleasure to be here.
Thank you. We've been in a pretty volatile time, especially since the beginning of the year. I think in part to us here in the U.S. Where would you say the best opportunities in credit are today?
Well, I think it's an interesting question, right? The question really comes down to where would I put my personal money in the current market environment? Really reading across asset classes. Equities have been a bit volatile. I feel, particularly comfortable being in, short duration, senior secured credit, provided that we can get the levels of downside protection and structural protections that you would want to get from a credit investment where your upside is limited. And then when it comes to, where would I want to be geographically, I've built my career around being a European credit investor, of course. But Europe, does appear to have a little bit of a resurgence, as chaotic as we may be, as maybe one of the more predictable, or rather predictably chaotic counterparties in the room. So right now, what I'm looking at is I very much prefer credit. I prefer to be a little bit shorter, have a relatively shorter duration, and tend to be senior secured.
You referenced it there in your answer, the UK, Europe, is that a more stable, say, safer bet these days? Are you seeing more interest, more questions, LPs, kind of leaning your way these days versus, say, the US? Is it more of a short blip right now that we're in terms of volatility in the US?
Well, remember, like any time of volatility, the first thing that most LPs do is that they take a pause and reassess, right? And that's very normal, of course. LPs have, predominantly portfolios are predominantly liquid, or at least will have a very large exposure to liquid markets, and they need to think about what we're going to do next. And then obviously people have a tendency during this time of dislocation, during any dislocation, to stay a bit closer to home, and a lot of the capital is obviously been allocated to the US in the past. But what LPs might also be thinking about today is, Europe used to be just maybe a little bit of a diversifier. Now the question is, should we not have more European exposure, not just as a diversifier, but actually also because Europe, is a bit of a counterweight potentially to what's happening elsewhere in the world, and maybe, maybe we need to have it in our portfolio. And it's certainly driving. I mean, we certainly see the interest, in our funds, has increased materially. But there are other factors at play for us beyond just Liberation Day.
Can you tell us a little bit more about NorthWall? I know you're one of the founders. So what does today look like from when you founded the firm, and when answering that, what gave you kind of the inkling, all right, I'm going to do my own shop. Me and my co-founders are going to go ahead and we're going to start NorthWall Capital. What did that look like?
Well, I mean, to start your own business, you need to have a little bit of what I call entrepreneurial naivete. You need to be just a little bit silly enough to suspend that rational knowledge that you're probably going to fail. And I have a lot of that, and I've always had that. So I've always wanted to be an entrepreneur. I'm very ambitious, not for any monetary reason, but I'm just a competitive person. And I like solving difficult challenges. And I think one of the challenges that I was really interested in solving is, how do you unlock, how do you monetize some of the value that you can get from these inefficient European credit markets? And many people have tried that, but then how do you do that actually at scale? So that's something that I've always been really interested in. It's not scale for scale's sake, but that's the difficult problem to solve. And so the kind of the journey started, just over 8 years ago, when we just started to do deal by deal investments. I remember our first deal in November 2017 was a £2.5 million bridge loan. We are currently in the process of closing a €300 million transaction, so many, many, many times bigger. The firm has grown from no discretionary capital to now having nearly 3 billion in discretionary AUM and growing very, very, very quickly. So it's been a wild ride, but it's been a lot of fun.
How different are, some of the strategies that you guys are in
Yeah.
from when you started to where we are here today? Because I know you guys are in direct lending, you're in ABF. Like, what do some of those strategies look like from when you first founded the firm to how they've evolved to where we are today?
Yeah. So look, I think at our core, we are private credit investors. And, with our background, my background, for example, is in distressed investing. Our background, we prefer the slightly more complex end of distressed investing. And that's really the DNA of the firm is, how can we provide capital, in the form of a credit instrument to counterparties that are experiencing an element of situational complexity. As we have kind of matured and as our firm has evolved and grown, we were able to find some of that complexity initially, predominantly in, off the run. I hate the word niche, but let's call it niche opportunities. But as our firm has grown, really what we find that complexity is in relatively urgent, but also not overly complex or risky situations where counterparty just needs a lot of capital. So one key aspect of our evolution has been that we've gone from sponsorless deals, with relatively small borrowers to dealing with some of the largest private equity firms in the world today. The other thing is, as we've kind of expanded our credit opportunities funds and they've, grown in size, we've explored interesting verticals within them. You mentioned ABF, for example. So we started to buy these unsecured consumer loan portfolios, predominantly very well seasoned, reperforming portfolios. But at some point, I guess it got a little bit too big to keep doing that within the credit ops funds. So what we decided to do is just to start an asset-backed opportunistic fund. And that strategy now has deployed almost €500 million over the last 18 months. And then you call it direct lending. We are not interested in competing in the direct lending space, but a natural offshoot of our opportunistic credit fund then also came, all of these deals where a borrower graduates to a lower cost of capital and we can provide them senior capital, still a very interesting kind of double-digit type of returns. And again, with situational complexity, but really also transitional and situational capital solutions, which I differentiate from direct lending, which is more of a flow business that we're not in. So, you've got you've got the credit ops fund, the asset-backed fund, the senior lending fund, and then we have then we lend money to law firms in our legal assets funds. And all of these strategies are really sub-strategies of the flagship.
And has the thinking on any of those evolved so we've been in at least for the last 10 years, figure low rate environment. And then we obviously spiked. Now we're in kind of, I'd say, a more normal interest rate environment, maybe a little still low historically, but has the thinking on any of those evolved as we've kind of gone up the rate spectrum a bit? Or have they maybe, kind of double down on like, hey, these were the right strategies for us, especially related to some of your comments around complexities and, in some of
Look,
these businesses?
I think the way to think about it, right? We have certain requirements for pricing and structure. and those are here, right?
Mhm.
Then, you know, what happens through the cycle is that in a cycle like the one we're in today, you have much higher quality counterparties kind of, you know, coming up to that pricing and those structural requirements that we have. And then, you know, during other times, we have to find value in, you know, more growthy type of investments, even though that's something we have a very difficult time with. So what I'm trying to say is that our strategy, you know, and our return expectations, you know, they change on the margins, but just because rates are higher, you know, we don't necessarily try and get a higher return. In fact, what we're trying to do in the current environment, just target better quality counterparties and get much better risk-adjusted returns, right? And especially in our credit ops strategy. So what is worse for us? The worst environment for our kind of, you know, strategy is an environment where, you know, we're kind of all going along, growing nicely. You know, rates are at zero, and you know there is no volatility and uncertainty. The current environment, where there is a tremendous amount of uncertainty and volatility, it doesn't require stress or distress. You know, the current environment, just every time an M&A transaction fails to close, every time a sale process doesn't generate liquidity, a bond deal doesn't close, it's potentially a performing situation where a liquidity gap has been created. And that is exactly something that we can go in and we can step into. And that's what we do. So it really isn't that market dependent and certainly not rates dependent.
So when you know, when talking to LPs, what are some of the biggest questions? Have those questions evolved given today's environment, say from the last few years? LPs that, you know, obviously know you, know your strategies and where you guys focus. You know, are there other questions that LPs are asking?
Well, I mean, the question that we used to get quite a lot historically was, you know, why should I be invested in Europe at all? Right?
Hmm.
I mean, generating higher returns in the US, it's more scalable, etc. So we're answering that question less and less. You know, now our credit ops is on fund three, so we're answering the question around track record, you know, a lot less. You know, and most of our LPs now, I mean, if we get questions today, it's really questions around, can you continue to deliver what you've delivered historically? And you know, how are you going to protect yourself in an environment of increased volatility? So we are, you know, just topically today answering the question around how the sanctions impact your portfolio and what you see. But generally, the trend, the questioning, and the interest in Europe, when you used to have to convince people 3 years ago to even look at Europe, today, you know, they come having already answered that core question.
Do you see that continuing at least the next few years, the next decade? Are you just, you know, kind of living in the current moment? I mean, what does the future of Europe? Because obviously some of this volatility will abate, it'll come down. We'll probably go back into more of a quote unquote normal balance. But do you think Europe's kind of on the upswing for the next few years?
Look, I don't think we're going back to zero rates anytime
Yeah.
soon, you know, if that's what you're asking. I'm also not riding any wave in the sense that, you know, I think it's, you know, the golden age of credit. Like we generated perfectly fine returns in 2020, 2021, 2022, when there was relatively, you know, when we're still in a relatively low rate environment. You know, and what I'm trying to do, and the reason I sleep well at night is because I'm not trying to build a business that's dependent on any certain macro factor persisting for any period of time, right? What I'm trying to focus on is, you know, how can we deliver value to our LPs? That means returns, transparency, partnership to our counterparties, you know, that come to NorthWall for, you know, very specific reasons, and to our team members where we're trying to deliver to them here a career development opportunities beyond just a paycheck, right? And I think so long as we focus on what we can control, the European market will continue to be messy enough and interesting enough over the next 3, 5, 10, 15 years for us to do plenty of things in it.
You know, with some of the counterparties you have, um, you know, have you seen some of the shifts of the higher rates and of the last few years? How much of a stress has that put on their business, ultimately the end borrower of your capital? Have you
Yeah.
seen that change
Yeah, it's, I mean,
dramatically?
It's a very good question. I think that borrowers are certainly experiencing liquidity crunches. They're struggling to, they're struggling to generate free cash flow after covering their debt servicing costs, and they're increasingly looking for alternative solutions, right? And that actually has increased the size of the potential opportunities for us, right? Because we are very happy to support a business that wants to reduce some of the cash pay leverage on its balance sheet, and structure something that has a pay if you can type of coupon, provided that we have a very substantial equity cushion, right? And then we think of ourselves as potentially being in a second lien position, but we're getting paid a high teens return while the equity is still deeply subordinated and still has a lot of value to fight for, right? So yes, it might be PIK at least for some period of time, but the reason that benefits us is that we are able to generate an equity-like return while still being in a credit-like position. And most of the time, our proceeds are used to pay back a few banks out of a banking syndicate. And that's the second trend that we're seeing. Banks are shrinking their balance sheet. It's the Basel Endgame. It's happened for many years. And what we're just seeing is we're not seeing a flood of banks leaving the market. But what we're seeing is that out of a syndicate of 5 banks, one just says, I don't want to renew, right? Or 2. And you just see that 20-30% gap in the capital structure that counterparty sponsors or non-sponsor businesses need to fill. And that's something that we're very well positioned to help address.
And when a borrower is coming to you, are they looking at the flexibility of your capital, the cost of your capital plays a factor, but when working with someone like you guys, are they looking for a long-term partner? Like, what are some of these motivations? Because the theory is always, if you can get capital from a bank, it's always going to be cheapest, but it could also be the least flexible, especially in these days when you have to maybe be a bit more nimble as a business. Are they coming to you because of flexibility? What are some of those motivations?
Look, I talked about our 3 stakeholder groups before, right? Our investors, our counterparties, and our team, right? And our counterparties are a core part of what we do. So the most important thing that we want to deliver to our counterparties is, genuine attempt to solve their problem and be a partner in their, in their businesses going forward. Like, if you have the option to go to a bank, we tell them you should go to a bank. We are never going to be your first call. We want to be your first, second call. You come to us in our credit ops business, at least. The senior lending business is a little different, but in our credit ops business, you come to us because what you need is transaction certainty and speed of execution. It's not always bad. Sometimes you put a bid in for a company, you didn't win, and then they call you back and say, you can have it, but you need to close in 4 weeks. You need somebody just to move very, very quickly. And this is where NorthWall can come in. We have a very tight investment committee. We focus on the situation. We all hold hands. We do the diligence, and we try to go there very quickly. But it costs you a little bit extra, and it costs you a much tighter structure, covenants, security, share pledges, whatever it might be. So our counterparties then have us in the capital structure. And, while we would be delighted to be their long-term partner, we understand that we were there at a moment in time. And in 2 to 3 years, depending on the end of the non-call, the counterparty will try to refinance us out. But what has really surprised me over the last few years is how many of our counterparties, of our sponsor-backed businesses, of our sponsors, have come back to us to talk to us about other situations in their portfolio. Because they know, number one, we will deliver. Number two, we won't waste anybody's time. And number three, we have no interest in owning your business. All we want is for you to take our capital, us to get it back, and give it back to our investors. And that type of symbiotic partnership has worked really well for everybody involved.
For some of those counterparties, is it kind of a pleasant surprise that the end game is not to own their business when they come to you guys, and it's part of the reason, like, hey, we can go back to them because we know of some of those things that you just mentioned?
I don't think that I think our reputation is just that we're really focused on establishing partnerships, and like, for me, that just makes good business sense. I started my career as a distressed investor, right? it sounds cool. It's actually also a lot of fun, but it's all about game theory, and it's a very difficult way to generate returns for your investors, right? I'd much rather lend you some money, you pay me back, and we do the next deal together, and you tell all your friends. It's much easier, it's much more scalable, and it's much more fun.
When looking off at least a little bit into the future, kind of what makes you most excited, whether it be the current opportunity, where the firm is going, kind of what's most exciting for you at NorthWall right now?
Look, you know, I love I kind of have the best job in the world as far as I'm concerned because I genuinely like working with people. I love investing. I don't enjoy talking to investors and managing those relationships. And so what I'm really excited about is just to be able to continue to grow, right? Growth in and of itself is exciting. It's fun. It's energizing, and to continue to find good opportunities. But at the same time, as an investor in this market environment, when rates are high, there's some volatility. You can extend phenomenal credit to high quality businesses and earn double-digit returns or even mid to high teens returns. That's something I get incredibly excited about, right? At the same time, I see my team going from 3 people to being 40 people to being excited and seeing their careers evolve. It's all the whole thing, the whole package excites me, right? There's no necessary end game, or anything else that I'm thinking about.
Do you have any interest in expanding beyond Europe to the US or anywhere else in the world? Has that been, something that's of potential interest?
That is, I think it's first of all very important, about 40-50% of our capital is in the US. We need to have a business development person, a member of our investor partnerships team that's based there permanently. We already have a US employee that looks after our legal asset strategy. And it's a very natural evolution of our firm to expand internationally, provided that our approach works there as well as it does here, which I think it does. So, never say never. In the medium term, having a US presence is certainly in the cards.
We have just a few minutes left, so I'd like to end with a little more fun questions as we go out the door. Do you have a favorite sports team, sport that you follow, or hobby?
Um, so if I'm not playing with my 5-year-old son, which, as cliche as that answer might be, is the best, I'm going to be running or skiing. Those are the
I
things I
have
love
I
doing.
have I have 2 boys myself, so I certainly understand the
Then you get
playing
it.
with the kids.
Yeah, it's the best.
One surprising thing about yourself.
Um, I once was abducted for 4 nights by feuding tribesmen in the Middle East.
Wow.
True story.
Uh,
You
that
can
would
Google it.
that would be the last thing I would ever think of as surprising thing
You,
about yourself.
you
Wow.
can you can Google it. You can Google
That
it. That was the
is
thing.
well, I hope obviously I hope you're okay from that
Everybody's
experience.
fine. Yeah, don't worry. Everything's fine. But
Uh w-
thanks.
Caught me off guard there.
Yeah, I did. I did. You feel bad. You don't have to feel bad. It was an interesting experience. I spent nights under the starlight. It was beautiful. That
uh
was the part.
one book that you would recommend reading.
I recently read Demon Copperhead, which, if you haven't read, I highly recommend you read it. It's a novel, and especially as a father, as a parent, you'll find it incredibly well written. But even if not, it's a phenomenal read. It's a page turner.
You've already said the most exciting part about your job, so I'll go with last question. One prediction for the next 12 months.
I'll give you 2.
Even better.
I will run another marathon, even though today I really don't want to. And the second thing that I've learned over the last 20 years, Todd, of investing in European credit, um, is everything will be fine. It'll be a bumpy ride, but everything will be fine. And that creates the opportunity.
Well, I think that's a perfect place to end. Fabian, I really appreciate your time. Thank you for at least spending a few minutes of your day with me. Continued success to you and the team at NorthWall.
It's good to talk to you. Thanks for having me
Thank you.
on.
Of course.
Bye.
Thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.DealCatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.